Hello, this is Bill Moreland with Bankrate Data. Today I'm going to spend a little bit of time talking about Amboy Bank. It's about a $2 billion bank in New Jersey. A lot to like about this particular bank, but this is going to be a follow-up to a topic I touched on a couple of videos ago, which was banks that are starting to do performing modifications, loan modifications, at the same time that they're starting to have delinquencies. It's a good example for a couple of things that we want to talk about. One is loan modifications or TDR, troubled debt restructurings, are sometimes a precursor. Not always. Look, and there's plenty of examples where banks can put things on. They can do a loan modification and everything's fine. What you're looking for is when it's being done into conjunction of other delinquencies. Because essentially, by lowering the payment, what you're doing is you're helping keeping that loan out of future delinquencies or future non-performing loans. The second thing is I annoyingly tell most of our clients, nobody's reserved. Anybody below $5 to $10 billion, you're reserved until you're not. And I know there's a lot of discussion about CECL and Basel and Camel and all these things that frankly, I don't have much of a working knowledge in any of these things. Excuse me. But what I will tell you is I think it's a lot of over engineering because typically you're reserved until you're not, and the bank can deteriorate that quick. Things like fast loan growth should play a factor, but I don't know if fast loan growth does, right? If you have a big stable portfolio that hasn't grown much, that portfolio can probably have lower allowance levels than a bank that's gone from 400 million to 700 million in commercial real estate. And so we're going to spend a little bit of time talking about reserves. And the final thing is, while rare, you will occasionally see issues in a call report. And I think there's one here. And we're not saying it's necessarily an error, but it does definitely look like there's been a classification. So Amboy Bank, $2 billion, $2.7 billion. It's going to be in New Jersey. And so that's important because essentially when we scroll down here and we look at the threshold alerts, we see these major alerts are going to be things that are in the bottom 5 to 7%. We can see that their CRE concentration ratio is 433%, which is high. 300 is guidance, but typically it's about 350 is when the regulators will come in and start saying, look, you need to limit your lending or you need to start raising capital. Their multifamily NPL is not coincidentally, which is part of this, the non-owner CRE concentration ratio is 6.25%. So if we click on this, we can see that there's a $44.9 million jump and pop down to the bottom with all the other similar sized portfolios, which are right there. They rank in the 98th percentile. So very quickly, they went from looking fantastic in their multifamily portfolio to potentially having some issues. But really, we should have kind of anticipated this, right? Because remember what I said, we see a very large increase in loans. So we'll come back to this in a minute. I want to go back to the main page. I want to come back down and I want to look at the CRE concentration ratio. So it's complicated because typically 300, 350 is about where a bank, 350, 375 is about where a bank starts to touch that limit. But New York, Miami, Chicago, Seattle, some of those banks and urban concentrations that are multifamily lenders, they will be allowed to run 400, 500. But what we see here is a significant increase, right? They were bouncing along that 350, 360, 370 range, and they were actually working that number down. We can see it went from 376. So this fits the pattern, right? Once you get to about 350, 375 range, there starts to get some pressure. And specifically for them, they were growing that portfolio, but they were growing allowance and capital faster. But two things happened here where that ratio, you always got to look at the numerator, you always got to look at the denominator. The numerator jumped substantially. Was that $54 million, which is higher than the 33 and higher from the 29, but not unprecedented. But really what you see is the tier one capital and the allowance fell. What is that? 58, $60 million. So why? Always why is the question. Come into tier one capital, and what you see is the tier one capital ratio drops from 16.58 to 13.27. And lo and behold, you see a drop of 379 to 319, which is about $60 million, right? So it's pretty close to that $58 million drop in the CRE concentration ratio denominator. Is it troubling they're at 13.72? I don't know. Perhaps not, but clearly it's much lower than they've been in 7 years. So the question is, why does Tier 1, once again, why does Tier 1 capital go down? And not always, but charge-offs are going to be a big issue. But like I said, there's a lot to like about this bank. If you come in and look at their efficiency, they generate a lot of income for their cost structure. Are they having? No, they have negative net charge-offs, which means they have no charge-offs, likely. They're getting recoveries. And we can see that going loans to 2000, charged off. It's been 2 years since there's been anything of note. Recoveries, yeah. So come in, you look at income and expense, you basically see that their provision is zero up until this number 500, which is still reasonably small. Their net charge-offs look fantastic. That's why that's fill-in allowance, because net charge-offs are negative. No charge-offs and a recovery. Recoveries will fill that allowance bucket. And their pre-tax income looks fantastic. So a lot to like about this bank, but why did capital go down $70 million? And almost always the answer is a dividend. So this bank is publicly traded, which has different unique pressures. But this is one of the reasons the CRE concentration ratio climbed. Am I particularly hugely bothered by this? No, but it is unique. It's curious, right? It's curious that they would be that aggressive going into a credit cycle, but maybe that not everybody universally feels that way. So let's go ahead and take a look at some portfolios. Going back earlier, what had caught our eye on this particular bank is that they had restructured some loans right there. And we saw that happen at the exact same time in two portfolios. Right there was a $18 million modification. Now that we're looking at it later, we can subsequently see it's still 18 million bucks. So that has to be most likely, but I'd say has to be interest only. That loan is making interest only. It's clearly impaired, and it really should have been put on non-accrual, but they're not, right? You can't put it on non-accrual if you're doing an interest-only loan. So they had to kind of keep it there. But this is where the performing is a misnomer. And what was problematic was that they had done it on two separate notes at the exact same time. And so it was a 9.68, and then subsequently it's 9.75, 9.75. Once again, interest only. So they're doing this to basically keep it out of delinquency. And so for how long, right? Does that last? We don't know. But the other thing that was problematic for this bank, why they did that, is if we go back to 30 to 89 days past due, they did have a loan pop into 1 to 3 months past due. And essentially, it was going to be a construction loan. Right there, we see it jump up. So right when this big $44.915 million note, or notes, maybe it's two, went early stage delinquency, they then decided at the exact same time frame, we have $27 million of multifamily and other construction loans, we're going to modify those. So what that's doing is it's making the situation look better perhaps than what was really happening at that time. And realistically, this also is a good segue, because if we copy this, what is the new loan that is problematic for them? And the new one is a multifamily loan. So if we come back here to multifamily, could we have seen that they were going to have issues, right? I talked about this a little bit earlier. Yeah, that's a lot of loan growth, right? None were early, very little early stage, but it did jump to non-performing. I'm guessing they put it on non-accrual right there. But notice the dollar amount. That $44.9 million multifamily non-accrual, I'm willing to bet is the exact same $44.9 million in the $44.915 that was construction other land. And I specifically went in and looked up the call report for these guys to make sure that there hadn't been an amendment, since our last update a couple of days ago. And no, it is. It's accurate. I mean, that's exactly what it was. So this looks like it was originally classified as a construction loan, and then they reclassified it as multifamily. Not sure what the reason for that is. Sometimes you'll see they will go back and modify or amend prior call reports. That doesn't yet appear to be the case here. So total delinquencies across the board are actually not up, right? Because, I mean, the modifies are not there. So we had that big jump of 50 million, 45 million, and it's still in delinquency. It's just moved from early stage to late stage and then moved to a different portfolio. But the reason that we primarily talked about this guy was this particular bank is if you come in and look at allowance, you're going to look at this, and I'm not sure what the drop was there from 33 to 27. I think it was a big charge off, right? That's what it was. That was a $6 million charge off that we saw. Yeah, right there. So there was a charge off that accounts for that big drop. But basically what you're looking at here is it looks reserved. It looks reasonably well reserved. I mean, 158 basis points is lower than they've been. So that's a little problematic. The bigger issue is they went from 1.5 million to 1.5 billion to 1.9 billion. That's $400 million of loan growth. That's 25% loan growth in the portfolio on a base in 3 years. All organic, that's high. The reason we had talked about them before was the coverage ratio. And so over here, if you look at the coverage ratio, we basically said, look, you're reserved until you're not. And how do you tell if a bank is reserved or not? Well, they were running $6.09, $6.17. So this is how many dollars of reserves do you have for every dollar of NPLs? And by any account, they were well reserved. This is not a criticism. I don't think whether it was Basel or CECL or Camel, there's all this stuff that goes into, is a bank well reserved? And I always tell people, no, they're never well reserved. They're just not. But you can't hold as many reserves. I'm a credit risk guy. I always see risks. I'm always looking for risk. It's both a blessing and a curse. But that's not how it works for reserves. Banks that are less than 10, 15 billion dollars, they're reserved until they're not. And so what had caught our eye was we'd created what's called an adjusted coverage ratio, where we added in the performing TDR. So this bank was cruising along at $5 and $6 per dollar of NPL of reserves, but when they did that $28 million of loan modifications, 18 and 9 in multifamily and construction, this should have been a precursor that this bank was not well reserved. But you didn't see it in the traditional coverage ratio. You still would have been getting the illusion that they're still very well reserved. But very clearly, they were starting to have issues. $44 million construction / multifamily, eventually delinquency that went from early stage to late stage and hasn't made a payment in 6 months, along with 2 interest only and a minimum 2 interest only modifications. So should we be shocked when all of a sudden this metric comes up and shows that they're not reserved? Well, 61 cents of reserves for every adjusted NPLs, it's lower than they've ever been, right? You have to go back at least 10 years before they've been that low. And you cycle down here to the other banks their size, they're in the 95th percentile. But if you modify it and add in the performing TDR, they're at 39 cents. And once again, scroll to the bottom, they're in their 97th percentile. So this is not to say that this bank is in any danger of falling apart. It's not to say, I think the bank's fine. It makes a lot of money. It's well run. It's giving a lot of that money back to the shareholders. But I would suggest this bank is going to have to start taking some charge-offs or some loan sales or some additional modifications. So I would suspect that their earnings income is not going to be as good in the next few quarters as it's been up until now. Perhaps they'll work through these issues and they'll be fine. But if you put enough banks that look like this into a bucket, that bucket does have some banks that start to have some issues and start to make less money. As always, if you have any questions, please reach out and give me a call. Thank you.